Thank you.
Uh,
Um, yeah, there's no doubt that this has been a challenge in our industry. We've been in a challenging market for a very long time. And then to have this, come up, debate it all you want, pros and cons, all this, who's the real winner here? You can argue that the real winners are the litigators and the attorneys. Is it really a win for the consumers and for people in this industry? That's still up for debate. Everyone has their own opinions. There's also a lot of misconceptions out there on what this really means. So educating yourself to really know the true facts and not opinions is vital, especially right now as we're coming close to the due date of all these changes taking effect. And those misconceptions out there, especially with consumers, what's really going on? You know, especially selling agents, you've got buyers, it is even more challenging because you've got this contract now that has to be signed up front, that you've got to have this agreement. Hey, you're going to pay me my commission, whatever amount that is. And that's a hard conversation to have because it's not something we've had to have before, right? As a selling agent, we're so used to the seller paying the commission. It's really not anything to worry too much about. If you even get a buyer to sign the buyer brokerage agreement, before the contract, or when you have to turn your contracts into your your offices and they do their check marks and, oh, you have to have it signed, and it's always been kind of an afterthought. But now it's got to be top of mind. First thing you do, you can't show a house, all that kind of stuff. So I don't envy what you guys are going through at all. I'm here to support and help offer what solutions I can offer. So that's what I'm going to talk about today. It's not going to be a super long call because, as you'll see, there's not a lot of options that I do have. I do have a couple of, I think, really good creative ideas. But there is still no indication from Fannie or Freddie, no publication, no lender letters, no nothing that says that they've decided anything. I'll show you the last letter they put out, but that was April 15th of this year. If that shows you, we're in August now, and this ruling is about to take effect, and still mum's the word from them. So let's just jump right into it. Again, it's not going to be a super long call today. At the end, we're going to do some Q&A. I think that'll probably take up, most of the time. If you've got any questions while I go through these, few slides, throw them in the chat, and then we can address them at the end. Here's my contact information. If we've never talked before, you haven't been on this call or one of my calls that I do with Mike, my name's Jodie Hatano with Rocket Mortgage, very well known brand out there in the industry. Always been a call center, online lender, but over the last year and a half, almost now 2 years, Rocket has put local loan officers in communities to help with reputation, because an online lender, it hasn't been the best customer service in some cases, and they wanted to show that they are invested in the communities, and so they put local loan officers. There's only a couple hundred of us throughout the whole country. I cover the Bay Area along with another colleague of mine out over in the Walnut Creek area. We've got some people down in Southern California, and maybe, well, one guy's in San Diego. And then we've got a couple of people in Northern California, but just a handful of us here. I can count on one hand how many are in California. I've been in mortgage for 18 and a half years. I've been in real estate for 21 years. So I've seen it all. This market's been a challenge. It doesn't scare me. It is what it is. It's the ebb and flow of the real estate industry as a whole. So I'm here to partner with you. Have any questions anytime, availability 24/7. Don't ever hesitate to call. All right, let's jump in. Okay. What we're going to talk about, welcome. We already did that. Lender solution to the NAR ruling. I'm going to talk about 5 benefits to your clients, and then we'll jump into Q&A. Lender solution. Okay. So before I show you the slide, because it's got some math and stuff, and I don't want you to get sidetracked, there is not a lot that lenders can do to help pay real estate commission. It's really never been part of anything that we have done in the past. Now, if we end up seeing that someone's short cash to close a little bit, or they need some funds for other reasons, there are ways that we can help with that, but it's never been specifically to pay real estate commission. Again, no letters out yet from Fannie and Freddie on how they're going to look at that. Currently, that's not included in the interested party contributions. I'll talk more about that in a couple of minutes, another slide. on down, and I'll tell you what that means. So the solutions I have right now, while I think they're creative for this particular issue, they can be done anytime. I mean, this isn't anything that we just started doing. And one thing to be careful of when you're out there doing your own research, which you should do, is if you run across any lender that says, hey, we can roll this into the loan amount to pay the closing, to pay the real estate commission. Is that a true statement? Yes and no. There's not any indication that we would ever say, or any lender, not we as in Rocket and Jodie, but in as lending as a whole, that would have a guideline that says you can roll in real estate agent commission. I doubt that's ever going to happen, because remember, what we're doing here is we're, as a lender, the collateral for the loan is that property, and it should just be that property. It shouldn't be other, facets of the transaction commission. Now, has it been in the past? Of course, right? Because every property that's sold that there's real estate commission paid, it's all kind of absorbed through what the seller's net is. So it has still happened. It's just, how do you say it? How do you explain it? So what I'm going to show you are some things that I could have done 15 years ago and that I can do right now. But it's just putting a spin on it to help your buyers and help you understand that worst case scenario, if the seller will not pay and it's not happening, and your buyer cannot afford that additional commission, no matter what it is, 0 to 2.5%, 3%, wherever it is, wherever you are, that's typical, or what you've agreed on in your buyer brokerage contract, I can step in and help. And here's how I can do that. First option is called premium pricing a loan for a lender credit. Premium pricing a loan, just in simple terms, means that the borrower is going to take a higher interest rate for a lender credit. Okay, and how that math works out, I've got a sample here, or I'm sorry, an example. Now this is a $725,000 purchase price at 5% down. As far as this is conventional, FHA, is 3.5% down. They haven't really made any indication either what's going on. FHA and Fannie usually kind of go hand in hand with guidelines and things like that. So they'll probably announce something at the same time in the future. But anyway, moving on. This is going to be conventional, 5% down. Borrower comes to me and says, hey, seller's not going to pay. I have got to get some money, some extra money here to pay my agent. Maybe they don't want to cash in stocks, or maybe they don't want to pull money out of their 401k. Here's a way I could help them. And again, remember, I can do this right now. It doesn't have to do anything with agent commission. They could just simply want this money, okay, to help pay closing costs, maybe set up their escrow account, for whatever reason. Now, they cannot get cash at closing. Let me just say that right off the top. Cash cannot come straight to the borrower. So we don't premium price loans to then turn over and hand cash to a borrower. The way this would work is on the settlement statement. This extra money that I'm about to talk to you about, you can see it's highlighted right here, $11,192. That's going to be on the settlement statement, but it's going to cover the real estate agent commission cost, right? So but let's just say, for all, to make it easy, that the real estate agent commission that this borrower needs to pay is 1.625%. And you can see here in this first box, it's highlighted, required discount points, negative 1.625%. That negative means it goes back to the borrower. But what would happen on the settlement statement is that $11,192 would be sitting there, and then the agent commission would be charged of $11,192. And so it's net to the buyer, nothing. So keep that in mind. We can't lend or credit to then turn cash over directly to the borrower. But here's how that would work. Now, maybe this particular borrower has already 1.375%, or I'm sorry, not 1 point, but maybe they've got 0.875% already that they can pay the commission. Maybe the commission's 2.5% and they need a little extra. So 0.875 plus 1.625 equals 2.5%. So there's the 2.5% that between the lender credit and the borrower, they can pay. So what we do is we say, okay, How do we get that money? Let me tell you this. A lender is never going to just outright pay real estate agent commission. That's not going to happen. I don't care how anybody wants to spin it. It's not. The borrower is going to pay for this one way or the other. In this particular scenario, they're going to pay for it in the interest rate. And I'll show you what that looks like. So the first box where it says 7.25%, ignore where it says /-1. That's not anything you need to be concerned with. What we're looking at is where it says required discount points. That's the actual pricing for this particular borrower. 7.25% would be the interest rate that they would have to take in order to get 1.625% back from the lender, which would amount to, for this particular scenario, $11,192. Now, 1.625% is going to be times the loan amount. Okay. So that's how we get that number. So discount points are always calculated by multiplying it by the loan amount, not purchase price, but loan amount. So 5% down, this particular scenario, if they needed money to pay commission, or if they need money to cover closing costs or whatever, then they would take 7.25% and it would give them back $11,192. Let's compare that to the same borrower that does not need to pay any real estate commission or does not need any lender credit. What is the rate at par? Now, at par means 0 points. So this interest rate is the market rate. I say the market rate for free. It's kind of how I say it, but it doesn't mean that there's no closing costs. It just means we're just talking in terms of interest rate. You can see the difference between needing that money to pay agent commission in this scenario versus not. You go from 7.25 to 6.375. Now, that's significant, right? That is 0.875 difference in interest rate. So what does that do for the payment? Well, let's look to the left here. Okay, so the example at $725,000 purchase price with 5% down with a lender credit of 1.625%, that principal and interest payment is $4,698. So that's what the borrower would be paying in principal and interest, taxes, insurance, HOA dues aside. We're only going to talk in principal and interest terms because those other parts of the payment do fluctuate from time to time. Rate without the lender credit, they would take 6.375% with no points. Now, you do see where it says negative 0.125. That means that we would be giving the borrower back $860 in this scenario. That's as close to par as I can get. That's a benefit to the borrower. If I took it to 6.25, the borrower would have to pay a little bit to get that. And so I wanted to set this at 0. That payment is $4,297. There's a $401 difference a month in payment between those two interest rates if the borrower needed money to pay agent commission. Now, let's say the borrower has no money at all besides their down payment, and they need the full 2.5 or 3% in lender credit. Probably not going to get there because that pricing, you're going to end up running into some issues with the APR being too high. And there are regulations that say you cannot charge X high of an interest rate on this particular loan. So there are some regulations that do exist. It's something that I'd have to run, individually to see, is this going to fly or not? But to give somebody a 2.5 to 3 point lender credit, that interest rate would be near 9%. So we're not going to do that. Okay. But we can help a little bit here. I think, worst case scenario, this is not a horrible, way to do this, but you also have to remember that your borrower or your buyer is going to every month remember that this is $401 more a month to have used you as an agent. You need to you talk about bringing a thing of value. That is something that you guys are really tasked with more now than you ever have been before. So what is another option? Another option that I think is actually much better than this is, oh, I'm sorry, forgive me. Let me go back and talk about this. Challenges to this approach. Affordability. So remember, we're increasing the interest rate to give a lender credit. What does that do? Payments $401 more a month. You could end up with an issue where your the debt to income ratio is too high, and maybe now they don't qualify, right? So what do? You can only go up to a 50% debt to income ratio on a Fannie Mae loan, Freddie Mac loan. That's it, no more at all. And in some cases, Fannie and Freddie will cap you at a 43% ratio. It all depends on the borrower's profile. So it's never anything that's just written straight in stone that you can always do this. You'll have one borrower maybe that's had some credit challenges in the past, or, something's going on, less assets, no reserves. And the system, DU, desktop underwriting, sorry to throw that in there, will not go over 43 for them, maybe a 47. So it is something that is individually, something I would have to assess for each borrower. It's not a blanket statement, but it could impact their ratios and kick them over so that now we don't get an approval on the loan and we've got to think of another option. The interest rate shock, of course, when borrowers are very interest rate sensitive. So to say, well, if I don't use this agent and I go directly to the seller's agent, the listing agent, I'm going to get almost a point better in interest rate. That's not a good idea, right? That doesn't benefit the borrower. They need their own representation. On a side note, I have someone in right now that doesn't have their own representation, and it has been very challenging. And they're asking me contract questions that I simply have to say, I cannot answer that for you. I cannot give you any guidance. Should you sign? Should you not sign? And I'm really wishing that they had their own agent. But they were afraid about commission. They did all this before I got to them, so I couldn't pass them on to anybody on our team. But interest rate shock, of course, lender loss. And I know this doesn't really impact you guys as much, but it does impact the consumer eventually, or it could. So let's say that we went back up to this first scenario and we gave an $11,192 lender credit. Agent got paid, moving on, borrowers made a couple of payments. Now borrower refinances. There are no prepayment penalties on loans. The first mortgages, that is. So the borrower could go and refinance. Now that's a sneaky way of kind of sticking it to who? The lender, right? So if the borrower does that, and we've put out this money, $11,192, and they've made only 2 payments, and they refinance, the lender's at a loss. And ultimately, this would be a Fannie Mae loss. Okay, so lenders, of course, we make money when we sell a loan to Fannie, Freddie, HUD, VA, all the other various investors out there. Most of the money we make is on servicing. But regardless, if this is a trend that started happening, then you can guarantee that eventually it's going to end up impacting lending costs in the long run, which will negatively impact affordability and consumer costs. So really don't want to do this. Don't want to do any of the sticking it to the to the lender that actually helped you get the loan in the first place. But again, I know that's not really anything that people are really concerned about. It does concern me because I don't want to see that happen, and then eventually the cost of borrowing, it has to be absorbed somewhere, and we're in a capitalist society. It's not going to be absorbed by any of the businesses out there, and you don't want to absorb that either, do you? No, I don't think so. So those are some challenges with that approach. There are some benefits to the approach. Borrower can finance instead of pulling out of pocket if they're short on cash. It does not impact the interested party contributions limits that I'll get to a little bit later on. And we can also adjust the pricing. It doesn't have to be 7.25 to pay back 1.625. Maybe they only need half a point. Well, that's a little easier of a interest rate change to swallow than almost a whole point. So it can be adjusted. Now, the option I think is best if we run into the situation where the borrower cannot pay commission out of pocket and the seller's not going to pay it. How do you get paid? Another option would be to put less money down. Now, this is the same $725 purchase price, and I've got this structured at, sorry, let me move that. Here we go. I've got this structured at 20% down. So as you can see here, interest rate 6.375, required discount points 0. So this is again the rate at par. So the rate for free today, 20% down. Jump right down with me to the next box right under that. And let's take a look at this. 6.375, same interest rate, required discount points 0. What is that LTV right there? Down payment percentage. I'm sorry, not LTV, but the down payment percentage is 18. So they've taken 2% less down payment. Now their loan to value is 82% versus 80. And now they've opened up that 2% to be able to pay the agent commission, still be fine with the transaction. No impact to interest rate at all. So very easy conversation to have. What's the impact to the payment? For this particular scenario, $725 purchase price between 20% and 18% down. The overall price is $149 a month, significantly less than $400. In this particular scenario, you go higher in a loan amount, then that potential, premium pricing the loan could get exponentially higher. So to me, I think this is a better option. Now, there is mortgage insurance on this loan, right? It's 18% down, not 20. So there is going to be mortgage insurance on the loan. You may hear a lender out there say, well, we're doing it with no mortgage insurance, but I guarantee you what they're doing is they're giving a little bit higher of an interest rate. It's called lender paid mortgage insurance because you're getting a little bit higher of an interest rate and then the lender's paying for it basically that way. So on paper, no MI, no mortgage insurance on the loan estimate on it. You're not going to see it. Borrower's going to think they got a great deal. But if you're at 6.375 with no mortgage insurance versus 6.625 with, 6.375 with monthly mortgage insurance versus 6.625 with no mortgage insurance, what is the better option? Well, of course, it's going to be to take a lower interest rate and pay a monthly mortgage insurance. And why is that? Because if you end up not being able to refinance at any point in time, maybe it's a qualification issue or, job loss or whatever, you've got that lower interest rate. The mortgage insurance on conventional loans can be canceled. And as a matter of fact, by law, after it reaches a certain time period in the loan term, it has to be canceled. So it follows the original amortization schedule. So this mortgage insurance is not going to be paid forever. In addition to paying it this way, monthly versus in an interest rate, you can come back to the lender. So you can call me in a year and say, hey, Jody, I know I put down 18% or maybe I put down 10%, whatever it is. There's some houses on my street that sold, and I think I've got 20% equity at least now. What can we do about getting rid of this mortgage insurance? That's great. Put you through the system here. Going to get an appraisal. If that equity is there based on this third-party appraisal, borrower doesn't order it ahead of time. It has to go through us. Then we send it off to the MI company. And then we ask them to drop it, and then they drop it. Easy peasy. Now you're sitting with a lower interest rate. This, to me, if it comes down to it, is the best option as far as what I can do to help a borrower, open up a little bit more money to get paid. Now, what are the challenges with this approach? Well, it is a higher payment, no doubt. Of course, it's all relative. What's this loan amount? What's the interest rate and all of that? It is a higher payment. It could impact debt to income ratio, even at $149. That still could if you're really tight. And it has mortgage insurance. So historically, people are like, mortgage is just a waste of money. Yeah, of course it is. Nobody wants to pay mortgage insurance. It feels like a waste of money. The lender's protected, but you're not. But this is a way to bridge that gap and deal with having to pay commission if you don't have the money yourself or don't want to, for example, let's say that someone's got 20% down and the rest of their money are in stocks. Well, don't cash in your stocks to pay commission because now you've created a taxable event and you're going to be down even more. Just put a little bit less money down and then let's put a little bit of mortgage insurance on there. Still much less than paying Uncle Sam a big fat tax bill at the end of the year. Benefits to this approach. Less impact to debt to income ratio, right? We just saw how that math works out. Premium pricing versus paying a little bit less down, $401 versus $149. No change in interest rate at that 2% difference did not impact interest rate at all. Now, one thing I want to say about that, please don't take from that and go in the future and say for 2% or 2.5% difference in your down payment, you're never going to have a different interest rate. It's going to be the same because it depends on at what level the loan to value is. So at 5% down versus 7% down, 5% down versus 3, it could change the interest rate. Also depends on credit score. So you may have somebody with a 700 credit score, 95% loan to value that would be impacted by interest rate if they went to 3% down, right? So you may see an impact there. The reason I did it this way is it is assuming 20% down that the borrower does have some money that we could work with. So don't take that as a blanket statement, but you just saw in the scenario, it didn't have an impact. Minimal MI, $59 a month, very easy pill to swallow at that purchase price level. That can be canceled. And then of course, no potential losses to lenders when the borrower refinances. So we haven't put out all this money and then have somebody refinance a couple months later and then we're stuck with it. So all in all, I think this is the better option. Let's see. At this point, before I get into interested party contributions, let me check the chat box here. Let's see. Oh, okay. No questions yet. All right. So we will continue to move on. Maybe. There we go. Okay. Interested party contrib. Oh, go ahead, Mike.
Has a question.
Oh, let's see.
Question. So if
Yes.
we so before the residential purchase agreement is submitted, if the appraisal will allow it, do we have the ability to increase the purchase price before the contract is submitted? And what would the impact of that be?
Before it's submitted to me, like before you
So
say,
yeah,
hey,
before we make the offer, say we have somebody working with you, they go through pre-approval, we determine that they don't have the funds available to pay for the commission. We also determine that the seller is not willing to basically pay it out of their pocket. Can we build that into the purchase price, build that into the offer before it's submitted to you? Because I know you and I had discussed that you can't change it kind of halfway through, but if we change that before it's actually submitted, will we then have the ability to basically have enough room in there to finance it in?
Sure. You definitely can change it after it's submitted. The challenge you may run into is if the appraisal is already done and then we go increase the purchase price, but we have an appraisal at the original purchase price, that could be an issue because going back to an appraiser and then saying, hey, we need more value. It's not a good question for anybody to ask an appraiser. I doubt you're going to get that. So this is definitely something that should all be figured out way ahead of time before I get the contract, but definitely before the appraiser gets a hold of it. Does that answer your question?
Yes, thank
Okay.
you.
Okay, yeah, of course.
If I can say something, we're going to increase the price in order to get money to compensate the buyer's agent is asking the seller for a concession. If we don't, because otherwise, how do you get the money? Right? Because if it's an increase in the price, then the money is going to the seller.
Mhm.
And how do you get some of that money to go to the buyer's agent? That's a concession. So what is, I believe, going to happen is that in the vast majority, not all, but the vast majority of times when the buyer writes an offer, if they're using the CAR form in paragraph 3G3, there's going to be a concession request to compensate the buyer's agent. And even though some sellers at the beginning might say, well, I don't want to pay the buyer's agent, every offer is going to say this, right? I mean, like they're almost every offer, because almost every buyer has an agent, and this is the only real effective way of paying that agent, because if the buyer pays off the side, like on their American Express card or something, right? If they want to write a check or something like that, they don't get to finance it. And so the scripts, and one of the things that I'm working on is something that when we submit an offer, we can include with the offer that the listing agent can give the seller that explains that we've built it into the price so that we can finance it. Right, but raising the price is building it into the price, financing it and asking for a concession.
I mean, the concept has been around for ages, you know, so it's not like, for example, when I bought my house, and of course, you know, Monica and Mike helped me with that. If I didn't have them and I went directly to the seller, and let's just say, my house was not $1 million. Let's just say it was for math purposes. Let's say that I went directly to the seller and it's listed at $1 million, and I said, hey, I want to buy this from you, but I don't have an agent, so take 2.5% off. Is the seller going to do that always, every time? No. I mean, it's always that commission's always been part of that, part of the transaction. So the concept is the same. I don't know if I explained that the best way, maybe not, but the concept's the same. It's just now there's more scrutiny, and how is this happening? You know, there's like, is this fair? Is this right? Is Fannie going to allow it? Is FHA going to allow it? What are you trying to do? But it's always happened this way. It's just now, with the way things have changed, we have to be more conscientious of how it's worded and how is it looked at. But I don't think it's going to be as big of a deal as it seems, but you know, we'll see. It's happening here in just a few days, this change, and it's all going to be kind of, you know, like getting on a roller coaster, and then eventually the roller coaster stops and you land back home, right? You come in straight. So I think that's how it's going to end up being. Bianca, when can the minimal MI be canceled? So really, when can it be canceled would be once you think that you've got the equity, we get an appraisal, and you do. If you hit that 20% equity, then we send off to some information and documentation to the MI company to say, hey, borrower has equity now, drop the mortgage insurance. If you don't ever do that and you keep this loan, it has to fall off. It follows the original amortization schedule, so that you get that in your closing documents, and it calculates as if you've never paid any additional principal. So if you have paid additional principal, that amortization schedule doesn't know it. Just pretend that it is a paper document that sits there and it cannot be altered. It has to drop off. I believe it's like, for the most part, on average, year 11. Now, for the most part, people are going to refinance out of this, especially right now, given the interest rate environment we're in. You know, we're looking at a little mini refi boom here happening 6 months, 7, 8 months or so, maybe a little bit sooner. That all these loans that have closed over the last 2.5 years are going to come in and say it's time to refinance. And in that situation, if at refinance that value's there, then the MI drops then. Okay. I don't see any other questions. Dimitri, oh, great. Thanks, Bianca. There's no handouts or anything like that. So I think you're good. Okay, moving on. Fannie Mae interested party contribution notice, April 15th, 2024. They have not released anything yet. You would think that here we are about to hit August 17th and they would say something to us, but they have not. So we're still sitting at the maximum limits for interested party contribution is between 2 and 9%. I've got a chart next that'll kind of break out what the differences are. It all depends on loan program, occupancy, what's the loan purpose? Is this investment, single family home? I'm sorry, investment, primary residence, second home. Those have different interested party contribution limits. FHA has more generous interested party contributions of 6%. And Fannie Mae is going to be capped at usually 3%. But next slide here. Now, sentence here to read. If a seller or seller's real estate agent continues to pay the buyer's real estate agent commission in accordance with local, common, and customary practices, these amounts are not required to be counted towards the interested party contribution limit. However, if you give me a contract and it says on that contract that buyer is paying selling agent commission of 2.5%, seller to credit buyer 2.5%, that has to count towards the interested party contribution. So it's all about how it's worded. So if you're getting close to wanting to write an offer, and I know you probably work with Mike, Raw, or whoever, give me a ring. Let's talk about it real quick before you send it in. I want to make sure that we don't have any issues about getting close to going over that percentage. As you can see in this chart, excuse me, this is the interested party contributions limit as of right now. No indication that it's going to change. Also something to think about when you're calculating the interested party contributions, and you may want to make sure you don't hit that limit. Things that are customary, for example, here in Oakland, transfer tax split between buyer and seller. That percentage of the transfer tax that the seller's paying on, well, call it my behalf or whatever, that's not included. So if it's common, customary, the splits, the percentage, that's not going to count towards interested party contributions. So don't worry about that. This is something that's going to be kind of like outside of what's normal and customary. Paying commission on the purchase and sale agreement would be considered. For example, primary residence, if the borrower is putting down less than 10% on a Fannie Mae loan, Freddie Mac too. So think of this. Anytime I say Fannie, you might as well think I'm saying Freddie as well. Cannot go over 3% interested party contributions. If we're at 2.5% to pay agent commission, you only have 0.5% to work with. If there's more money that they put down 20% or 25% to, 10% to 25% down, 10.01, that interested party contribution goes up to 6%. So what would I do in this case? If I had a loan and we were on the verge there and we were at 90% loan to value, I'm going to have that borrower put down 0.01 more percent. On $1 million loan, that's $100. And now all of a sudden we're at 89.99% loan to value. And guess what? My interested party contribution went from 3 to 6. There, bridge gapped. Let's go to closing. Second homes is not allowed on Fannie for interested party contributions if it's less than, if it's 90% or 10% down. Now, we do 10% down second homes, but for the most part, people buying second homes usually putting 15 to 20% down, so we don't really run into it that much. Investment property, max at 2% all day, every day. It's always been like that. Doubt that's going to change. All right, I think, okay, FHA. Sorry, I have my wrong glasses on, so I can't see this perfectly. Primary residence on FHA, as you can see, it doesn't matter what they put down. Of course, they got to at least put down 3.5%. But it's always going to be 6% interested party contribution. Remember, FHA is a little bit more expensive of a loan because of the upfront mortgage insurance premium, but it does have a much lower interest rate, but it does have a more generous offering for interested party contributions. Okie doke. And the reason that says not applicable for second homes and investment property for FHA is because you can't use FHA for second home and investment property. Okay, 5 benefits to having your clients work with me at Rocket. Well, of course, I've known most of you guys for a very long time, and you know kind of how I work, and that I'm committed to the success of helping bridge the gap of affordability and creating more homeowners. Rocket's motto of mine is helping everyone home. And I think you can see that in my work. I think it's very important, especially given everything we're going through right now, to streamline the home buying process. I probably talk about this every single time I have a call with you guys about being a partner, working together. When we know what to expect from each other, that translates into a much better experience with the home buyer or seller. You know, I'm happy to work with sellers too. Don't think it's just buyers. Sellers got to buy too. So I think that it helps us, you know, presenting a united front. And then of course we can combine our years of experience, and that's always cool. Effective communication. I'm a big communicator. Ensure all parties are involved and on the same page going forward. Biggest piece right now, I think, is so incredibly important is a verified approval. I see so much more success with my own borrowers when I've put them through a verified approval than when not. I've got 2 closings next week. The borrowers did not want to go through verified approval, and we're now getting conditions, and they're stressed out. And I'm like, well, I'm not going to ever say I told you so, but we could have got this ahead of time. And then now you could be furniture shopping. Don't buy it before closing, but you could be doing all the exciting things. But anyway, the verified approval is so important. It is such a quick turnaround as well. If I have it in by 7 p.m. tonight, I'm going to have that out by 6:30 a.m. the next day. You cannot get faster than that. It's not overnight underwriting, but our underwriters are on the East Coast, and they start at 6:30, which is 3:30 our time, and I've got that letter in my inbox, and you can make that offer. No finance contingency, credit, income, assets, underwritten, and not just underwritten, but all conditions clear. So we will not issue that verified approval unless we have all conditions. And I mean, I've got to have proof you've paid your rent on time for the past 12 months. We take it to that level because it's so important to go ahead and get those things taken care of ahead of time to avoid any potential challenges from contract to close. Of course, enhanced customer service retention is greatly increased when we have a verified approval. It also shows you as the agent that your buyer or your seller that wants to buy is in this, right? They're putting the time, the effort, they're providing bank statements, pay stubs, W-2s, tax returns, if needed. They're showing that they're committed to this process, and they're not just wasting your time. We all, kind of hang on to each lead we get, and we want to make it into something, but we all know a lot of buyers, they want to buy, but maybe they're not committed at all. And it's a dream, but they never want to put any action to it. That's how you can tell, is your buyer invested or not? Will they go through verified approval with me or not? And how quickly are they going to be able to close if they do that? Well, really fast, 7 to 10 days even. So I've got, I think, some great solutions here to the challenge of you guys having this, commission issue. And I'm happy to work through anything. If we do the verified approval with your buyer, not if, but when, we're going to uncover those solutions then, right? You've already probably got a buyer brokerage signed at that point before you send them to me. So let's go ahead and figure it out. Worst case scenario, buyer, this would be what you would be looking at a payment. If in fact you found that house of your dreams, please don't let the commission get in the way of you making an offer. Let's make it work somehow for you. You found the house of your dreams. Let me come in and help you bridge that gap so that you can be successful. And I promise, after it's all said and done, it's going to be worth it. I think that's all I have. That's an old one. So let me just exit out of here. That's all I have now. Mike, if you want to take it back over, feel free. We can do a Q&A, and I'm happy to answer any questions I can.
The only question we have pending is from Juan, which is financing of solar panels.
How a homeowner can use direct equity line to pay cash for a solar system. Credit score of 530 is going to be a challenge anywhere you go, especially when you're talking about equity lines. I don't know, that might be something they'd have to go through like a solar financing company for. That's a challenge. You could also ask them to see if they qualify for like PACE. There's some government programs out there too, but I know, Mike, sorry.
No,
I don't want to break your computer.
I know where one is. I won't be selling that house, so go ahead with the PACE.
Yeah.
I know a guy on the street corner downtown that makes loans. I'll let you know. So
There you go. Yeah.
give you an envelope at the end. Their collection is tough. That's all.
Yeah.
So let me ask you a question. So it is very likely that most of the time there's going to be a seller credit. Now, you had said something, and I just wanted to make sure I was clear. If we use the purchase agreement, the residential purchase agreement from CAR, that section I texted you earlier, 3G3, and the idea of 3G and 3G3 was to separate a seller credit for closing costs from a seller credit to pay a buyer's agent commission. And the assumption, I assume, was that by splitting them, it would make it easier for the lender to identify that that 2.5%, as an example, for the buyer's agent commission wouldn't be part of the 6-9% or whatever seller credit. Is that correct? By
It,
splitting them?
well, it will be if it's worded like that on the contract. If there is if their verbiage says seller to credit buyer 2.5%, period, forget commission or not. That's interested party contribution.
Well, see, in a way, I'm not sure that this is going to be that meaningful, because how often do we see, even on a Fannie Freddie loan, us pushing the maximum seller credit?
Hardly ever.
I mean, I don't think
The only time it comes up for me on the lending side is if, let's say the borrower wants a little bit of a lender credit to help cover, closing costs, but they're also getting a seller credit, a certain amount. If I combine those two, sometimes it can be too much. But what do? I just lower my lender credit. The thing is, all we have to do is make sure we don't go over that percentage and that no money goes into the borrower's down payment.
Right.
Yeah.
So
But
just
it's hardly an issue. It's really not that big of a deal here because of how, the customary,
Right.
buyer seller paying.
and for those of
Cost.
you, just to make sure we understand that when Jody's talking about interested party contributions, we call that seller credit. Right, that's the same thing. It's just the lender's words. So what did the Fannie Freddie letter mean when they said that a credit for buyer's agent's compensation, if normal, if customary, would not be part of that limit if it sounds like it's going to be part of that limit?
Meaning, as it is right now, you know how you guys don't ever give me a listing agreement or the buyer brokerage agreement? But that listing agreement says you're paying, the seller's gonna pay 5%, and then you send all that, you send your commission demand over to title and all that. We never see that. So it's never an issue for us.
But
But
you
if
see
you put
the
it,
closing statement.
right, but it's not part of the contract,
Right.
the purchase and sale agreement. It's
Right.
a separate agreement that you have with the seller, the buyer's agent, and the listing agent. It has nothing to do with the purchase and sale agreement.
So,
If you,
go ahead.
so if you put it in the sales agreement, then it becomes a part of the sales agreement, and then it's going to be counted against the interested party contributions. So that letter, yeah, oh, sorry, go ahead.
Go ahead.
No, go ahead.
So if instead of using paragraph 3G3 in the residential purchase agreement, we use the EXP direct payment to the buyer, to the buyer's agent, and we didn't necessarily show it to you, but we turned it into escrow, would that avoid that issue?
If it's not in the contract and you just kind of carry on as usual, if it's not in the contract, I don't see how it would come up. But
You see,
because we see commission on the settlement statements all day, every day, but we don't count that as interested party contributions because you're not paying the borrower, you're paying
Right.
the agent.
right.
The
So
problem is when it says that the seller is going to credit the borrower or buyer.
right.
That right there is what the challenge will be.
Right. So if the borrower buyer was, for whatever reason, pushing the limits of the interested party, the seller credit allowable, and instead of putting it in 3G3 where you're asking in the contract for the seller to pay the buyer's agent, we executed the other form that EXP has, which is the direct payment from the seller to the buyer's agent, which all we really need to do with that is get everybody, by everybody, I mean the buyer and the seller, to sign it and stick it in escrow. Right, and then it becomes an instruction to escrow to pay for the seller to be paying the buyer's agent directly, and then that wouldn't affect the overall limits, correct?
Correct. As long as the seller is not paying the buyer,
Right, well, that's why it's,
then you're clear. Yeah,
that's the whole purpose of that form.
right.
Boy,
But if
EXP
it, yeah,
was smart to write that form.
yeah.
Yeah.
Mhm.
See, I'm glad we're having this discussion because as I had talked to you earlier, my assumption is that most of the time, and for most of the time it would work, people would just check the box in the purchase agreement and write in the amount. And it's true that we rarely push the seller credit limits, although there have been, I can recall sometimes, and but very rarely. So it's usually not an issue, but if it's going to be an issue, then if you're on my team, we need to talk about that because the way we would structure it would be different.
Mhm.
Um,
Yeah.
but
And if Fannie puts out a letter, trust me, I'll get with Mike and we'll have a immediate, we'll call a meeting and go over it and let you guys know so that you've got all the information you need to be
all right.
well
So
informed.
Anna is asking if we don't have that EXP form, which I assume means you're not at EXP. And then is there a comparable form from CAR for us to use? The form that's available with CAR is called the SPBB, which is called the Seller Payment to Buyer's Broker. And it's connected to paragraph 3G3 in the residential purchase agreement. However, if you're up against the limit on credit, then that's not going to help you. Now, if you're saying, gee, I mean, first of all, if you're not at EXP, give me call me. And the other thing that EXP has done, you'd have to ask your broker, but EXP has open sourced all of our agreements. We did not copyright them. We didn't. And even our seller and buyer toolkits are open source in that we didn't copyright those either. And as I was explaining yesterday, we did that because we feel sorry for all of the agents that are working at other brokerages that don't have that much help. All right. More, any other question? Michael Pine, he's very polite. He raises his hand.
Yeah, quick question. This is really to both of you, on what the easiest way would be. Let's say we're working with somebody and they're just like maybe $1,000 short or $1,500 short on the commission, and we say, okay, hey, I'm, no big deal to me. I'm getting most of it. Is the easiest way to reduce it by then giving them a credit, or is it easiest to reduce it by adjusting the agreement with them?
So I would say that you would modify the terms and reduce it in the contract. The credit might, like moving it from one pocket to the other, have the same effect. However, legally, the agent, what you're doing is contrary to what the contract says. Because the contract says you're getting 2.5 and then you're giving a credit. You could write that in, but it would be easier to just modify the contract terms, lowering the amount of compensation to match and sticking that in escrow, and that you'd give a copy to the lender, but and just stick it in escrow. We're probably not going to be doing as much crediting by the agent to the buyer because it's like, why? The buyer is paying you $20,000 and then you're giving back $3,000. Why don't we just say 17,000 and be done with it? It's less paperwork and it's a little cleaner.
Mhm.
I thought.
I agree with that.
Thank you.
Well, if I can leave you guys with one, because we're hitting time now, if I can leave you guys with one more little tidbit here. I am giving a $2,500 lender credit for anybody that applies. You don't have to close. It doesn't have to be a verified approval, just a pre-approval. For anybody that applies with me this month. Extra $500 if it's today. Can't tell you why.
How much, how much,
3,000 of it's today.
how much does the agent get out of that? Just
They get a big fat thank you from me
no
and a
red,
successfully closed loan.
no red envelope.
Yeah. But definitely give me a call. I'm ready to help anybody.
If you're working with a buyer, talk to us early in the
Mhm.
process. Both Jody and I talk. I'm working with Rod to modify our forms for writing an offer. You need to understand that if your buyer wants to not have any contingencies, and I'm making it so it will in the form take them to another section that warns I want them to see the insurance advisory. I want them to see that. And I want them to see the non-contingent offer advisory that explains what the downside is that if you have no contingencies and then you can't get insurance, right? You know, what happens? And the answer is you don't get a loan. And then if you don't get a loan, you don't buy the house. And if you can't buy the house, you could lose your deposit. So there's a domino effect of bad things. And we need to be clear on this up front as to what the issues are. Talk to us.
Yeah. And I also, just to piggyback that, and call out one part of that, when you mentioned insurance, I did have someone last week who could not, we ended up closing, but they could not find insurance coverage for their property. And it was a challenge. We were getting kind of nervous. So we did find it. I found a broker out in Pleasanton that was able to write a very affordable policy at half of what the borrower thought he was going to be paying. But insurance, as you all know, a lot of insurance companies have backed out of California and coverage has exponentially increased. Like I have someone right now that's paying $6,000 a month for HOI coverage. Nothing fancy, just their coverage. They're down in SoCal, so kind of in a higher fire potential hazard area. So it's very expensive, and he was shocked. So when I put my borrowers through the verified approval process, I am telling them, go ahead. You don't have to bind the policy, but go ahead and shop. Find out, throw a couple of property addresses out there and find out, that something, you see a house right there you like, but you're not ready to make an offer. Give that address to your insurance agent. Tell them to give you a quote. It should be, close to this, similar. Let's go ahead and find that out now. If it's going to be 1,500 versus 6,000. We need to know that ahead of time. Do not want to have a debt to income ratio issue right before closing because we waited to get insurance. So these are little things, little details in the transactions that have to be addressed up front. Another reason I think the verified approval is just, I'm almost to the point where I want to require it for anybody I talk to be quite frank.
And
Lots of moving parts in this market.
it also, if you represent the buyer, makes the buyer's offer stronger. Because one of the things that I would say to a seller is that in evaluating which offer you're going to take, it's not just who has a concession or not. It's not just the net. And if you don't think it's not just the net, the question is, well, if it was an all cash buyer, could they negotiate a lower price? Well, yeah. Well, so the seller would net less, but there's certainty that comes from the non-contingent all cash offer. And so they will change their pricing strategy based upon terms and conditions and contingencies. And if one of the things the seller would look at is how firm is the buyer's financing. It may not be cash, but it might be closer to cash than somebody who has a little short pre-approval letter from their brother-in-law who's a loan agent from a company no one's ever heard of.
Right.
All right. Have we seen we did have enough time?
Yeah, we hit the hour mark.
All right.
I'm just putting my contact information in case you guys don't have it yet.
They should in some of the information I've given them, but
Yeah,
they could probably find it if they Google search Jodie Hatano Rocket Mortgage.
you can definitely find it. There you go.
All right. Well, thank you very much.
Thank you. Appreciate it. Call me.
Thank you.
Thank you, Jody.
Thank you.
Thank you, Mike and
Bye.
Jody. Thank you, Mike, as always.
Okay, thank you.
Have a great day. Thank you all.
Thank you
Great
so
job.
much.
Thank you so much.
We can't leave
Bye.
until we're done with thank yous. All right. Let's see.
Yeah.
Okay, thank you.
Bye.
Bye.
You have to get all the thank yous so you feel good about your
Aw.
job.
We
Thank you,
Thank
thank you.
already feel good about it. All right, bye,
I
Mike.
appreciate it. Bye.